This content is brought to you in part by Supreme Auctions, the only luxury auction company recommended by the Institute. Supreme Auctions is widely recognized as the first auction company to design a program to work alongside and in partnership with luxury real estate professionals and their clients. Go to supremeauctions.com to learn more. Hey, Jonathan, how you doing today?
I'm well, Diane. How are you?
I'm doing great. Thank you so much for being our guest today. The topic really is around this active market in real estate at the luxury level, right? And then really, who are these folks that are going about and buying these homes that we keep hearing are just kind of going off the shelf? And so, you know, you bring a unique perspective as a tax professional and really as someone who focuses almost exclusively really on the high net worth and ultra high net worth. So the Institute, and there's all kinds of different published like guidelines of who is high net worth and who is ultra, or I guess now there's a new category called very, right? So it's high net worth up to 5 million, very high net worth up to 10 million, and then 10 or 20 and above is the ultra. But in your unique role, right, you have another layer, right, of determining whether or not someone actually needs to work with you. And that's complexity, right?
Yes, that's right. Yeah, so complexity is something that drives a lot of non-ultra high net worth or non-high net worth people to seek a CPA and get professional advice, just because there are some opportunities that they may not know about in their complex world, whether it be their small business or they have an investment portfolio, or they might have different types of Bitcoin or currency that creates complexity that they just need assistance with. So a lot of times I'll pick up clients and work with them who aren't fitting into that normal demographic of high net worth, but they still need really good advice to help minimize their taxes.
And so the folks that cross over into that high net worth and ultra high net worth, can you walk through a little bit of the complexity that you're referring to? Like what makes someone complex other than the things you've already talked about?
Sure. I would say a lot of high net worth or ultra high net worth individuals have entities or trusts that they've created that add complexity to their whole picture. They might have investments or holdings in various states. So they have multi-state filings that all kind of work together in different and varying ways. Different strategies around recognizing income that creates an opportunity that they need good advice from a CPA to help with throughout the year, and understanding their estimated taxes. A lot of these high net worth people don't have withholding from their wages, so they owe taxes each quarter. So understanding the right amount to pay in without paying too much in, but also minimizing any related penalties for underpaying.
It's so interesting, right? Like we think about, for the vast majority of us, we think about, oh, I'm going to get a paycheck and someone's going to already have taken out what I owe, regardless, right? Because you do also have folks who are W-2s, right? But they just have really big W-2s.
Right. Yeah. Obviously, we work with executives and high earners, but once you have a certain level of income, you start spending that income on other things that create complexity. So a lot of times those people kind of spill over into a different bucket of complexity just because of what they're purchasing or spending or saving their money to acquire.
So in today's housing market, right, and we've been watching this, you know, the Institute's been watching, obviously, this North American luxury market report, and by city, we put this together for years now, 3+ years. And what we're seeing in luxury, which we define as the top 10% of every market. So every market, regardless of where you are, there's luxury. And so what we're seeing is this incredible what I call a confluence of events, right? It's not any one thing. So if at a cocktail party today, people talk about openly the value of their homes, right? And what's happening right now, we look at and say it ties back to all of these complexities. It's not just the low interest rate environment, because if you're a high net worth or high wage earner, right, if you take a lot of income, you no longer can really write off a significant portion of a large mortgage, right?
Right. Yeah. Under the Tax Cuts and Jobs Act that came out a couple years ago in late 2017, now the mortgage interest limitation is capped at a principal balance of $750,000 for newly acquired homes, principal residences. If you're refinancing, those limits are still up at $1 million. But if you're acquiring a new principal residence, that 750,000 cap is in place.
So a sophisticated person who has $1 million mortgage, they would take a hit if they sold that home and then moved into a home they could only get a $750,000 mortgage, right?
That's correct, yes.
Yeah, because one of the things that is part of this confluence of events or this phenomenon is people aren't moving, right? And
Right.
One of the reasons why could be because they're sophisticated enough to understand they're sitting on a good mortgage at a low interest rate that's at a point where they can no longer get that loan.
But they can refinance to get a lower interest rate, which I saw a lot of my clients do. I did personally as well in the past 12 months after interest rates really dropped to a kind of new lows. And so you can refinance and retain the same $1 million principal deduction amount or limit without having to drop to 750. It only applies if you buy a new property, a new home.
It's so interesting, and it's one of the things that we teach in our course as we try to unpack and unlock this high net worth individual. One of the things that they count as a hobby is their investments, and their number one person that they consider for advice is their tax professional, right? So in that, we get a lot of gasps when we put that up, because most people don't realize how entwined and intertwined you are in someone's actual life when they are high net worth and ultra high net worth and are your clients. So when we think about what's happening right now and someone picks up the phone and calls you, you say, you know what, I'm going to run over and pick up this new house. I want to, upsize, downsize, whatever, trying to decide between picking up $1.5 million mortgage, right, or using my investments to pay that difference. Can you walk through how you advise people on this?
Sure. So a lot of it has to do with considering the amount of the interest that is deductible. And as we were talking about before, under the new tax law, that limit is at a $750,000 mortgage principal balance to determine deductibility. If you have a $1.5 million principal and you pay $60,000 of interest, only half of that is deductible because it's capped at $750,000. So it's understanding that, you can always finance at that amount, but part of it is no longer deductible, and you have to understand the difference between how much you're paying and what you could get in the market doing something else with your investments, and kind of the trade-offs for that time value of money.
It's interesting, right? Like this, and as we teach, this is a high interest point, right, for these folks, because as they get up into that level, they lose deductions. So deductions really are their single and most primary interest, right? Like this
Right.
is what they're interested in.
Yeah. So under the tax law currently, most individuals can only deduct a few things as itemized deductions. They can deduct mortgage interest up to a $750,000 balance, or $1 million if they have an older loan before 2018. They can deduct charitable contributions, which are a great way to make a deduction and reduce taxes. And they can deduct up to $10,000 of state, local, and property taxes, which most people in the luxury market who own homes are paying way more than that. So that deduction is very much capped in the current environment.
So this answer to sell your house and go somewhere else is really not as simple as, hey, the interest rates are low, right? That plays into it, but all of these other things also play into that. One of the other things that now here we sit in 2021, and 2017 was the Tax Cuts and Jobs Act. And now we're in a new administration. And so there are some things proposed that make 2021, even with all of the conditions that you've discussed, also could make 2021 something for people to look at, right? And make some moves. So what would those things that are being proposed, like, can you talk about that a little?
Yeah, so on the campaign trail, President Biden, then Vice President Biden, was talking about what he wanted to do with the tax plan, which most candidates are going to do. And what he's proposing on the campaign trail and what he's reiterated during his address to Congress a few weeks is that he wants to increase the tax rate for the top tax rate from 37%, where it is at the moment, back up to 39.6%, which was the rate right before the Tax Cuts and Jobs Act went into play. He wants to treat capital gains for people who are earning more than $1 million as ordinary income instead of the reduced, more preferable tax rate that applies to qualified dividends and capital gain rates right now, which is 15% or 20%, depending on your level of income. There's some thoughts about changing the amount of deductions, so maybe bringing back some of these state and local taxes so you can deduct more, but then there's a limitation on your Schedule A, your itemized deduction schedule, that reduces that amount. So there's just all these different things that are coming into play that might impact people who are in this high net worth or ultra high net worth regime.
So this idea that you have a home that has a value of, I'm just going to put it out there, like $3 million, okay? At $3 million, and let's say there's $1 million gain on that sale. Today, what is the limitation to the exemption on that?
Sure. So currently, and they're not planning, they haven't discussed changing this under a potential tax bill. So this is probably going to be the same both before and after any tax bill. There's a $500,000 for a married couple exemption from being taxed on that gain. So if you have $1 million gain, the first $500,000 for a married couple would be treated as exempt from taxation. And most states follow that as well. So depending on which state you're in, that is also followed. If you're single, it's half that. So $250,000.
So after that, a married couple has $1 million of gain. So the $500,000 this year is taxed as a capital gain, right?
Yeah, so that's for your primary residence if you live in it for more than 2 out of the last 5 years. So it's not just holding it for more than a year, it's living in it and treating it as your personal residence for 2 or more years out of the last 5 years.
And at that point today, it's considered a capital gain, which is taxed at the lower rate.
Yes.
From, like, I'm not asking you to have a crystal ball. That would be cruel, right? But when you think about what's proposed, actually, with all of this under consideration, if the capital gains goes to a higher level and maybe even looks like ordinary income, it would benefit someone to sell this year and take that, correct?
Yes, that's correct. Yeah. I mean, the tax rate, if they were to wait until 2022 and this proposed legislation goes through, would almost be twice as much of tax they'd be paying on the transaction as they would if they sold today.
So when I hear things like this, I think about would that slow down this very active market, because suddenly, capital gains is again sort of in that category of what these folks think about a lot, right? They think about you a lot. You're very important to them, but also how do they, make sure the decisions they make don't come back and haunt them later. So in this planning process, are you having this conversation right now with people?
Sure. We're talking with our clients kind of about the proposed legislation, what they think about it. And obviously we don't have a crystal ball. They don't have a crystal ball. So it's kind of talking about what might happen and how to hedge against some of the increases in taxes now while you still have the opportunity to plan. So we've talked to some clients about harvesting gains in their portfolios. So selling securities and recognizing the gain while the tax rate's lower or known to be lower right now. So it's just kind of understanding how can you kind of recognize some of this income now that the tax rates are lower than they might potentially be next year.
Everybody likes to talk about the housing market. Like I said, it's the cocktail party talk today. But yet I think this part here, right, all of these complications for someone as they make that decision to sell. I think really out there in the world, people need to recognize how many things come into play for people. So when we think about the drivers, right, the drivers of liquidity, where, my goodness, if you were invested in the market in the last 3 years, in the stock market, the S&P, let's just pick that. So if you were invested in the S&P 500 in the last 3 years, you have extraordinary gains. And you're staring down the pike of potentially in the future, those gains being taxed at a higher level. So this creation of liquidity in 2021 that people are looking at and they're coming to you with, and now suddenly they're looking at their primary residence extremely differently. I know I am, you are, right? We're all in our homes. We're back, right? But we've had an experience that we can't unhave, right? You can't unring that bell. So when we think about all of these drivers together and you're sitting down and talking to folks, like, I think it's really important to convey that complexity in this environment where we're trying to get people to move. Let's be real, right? The part of the bottleneck of inventory is people aren't moving. So if you're a real estate professional or a high net worth individual, what should you be considering right now in this moment in time in 2021?
So specifically for ultra high net worth individuals who have a potentially taxable estate, a lot of my clients are doing some estate planning. There's a lot of talk about under the tax laws that might come out in the next year, the estate, the lifetime exemption going from about $11 million per person down to $3.5 million or $5 million per person, which is a huge decrease from where it is right now. And that went up with the Tax Cuts and Jobs Act in late 2017 from about $5.5 million to 11 million. So it doubled overnight. So it's this amazing opportunity for these ultra high net worth people to transfer wealth to the next generation. But if it's reduced with any tax legislation that comes out, all of a sudden they're back down to where they were before. So a lot of those clients in particular are really focusing on doing some estate planning while they have it available at the higher rates and transferring it to the next generation.
Yeah, so you live and breathe this every day, but for folks like us, right, we hear estate tax and we think you have to die, right? But that's not true.
Right. So while you transfer wealth while you're alive, that's making a gift. So gift and estate right now are kind of aligned with the same lifetime exemption being used either while you're alive or dead. So you have $11 million total. You can use it now or later, or part now, part later. So while you're alive, you have more opportunities to be very intentional about who gets it and how, and you get to see how they use the wealth that you've transferred to them. Whereas if you wait until you die and you wait for your will to transfer everything, you don't really get to enjoy it. Well, I mean, you might from a different place, but you don't get to see it in person and see them enjoy it.
So that's great information. And again, so much to think about. And so as we think about how professionals network together and work together, okay? So when you think about how you learn and how others get to learn from you and this network that you have, because you've talked about estate taxes here, and so clearly you network with other folks.
Yes.
And we teach our members to really reach out to the CPA community, right? You're with a large regional firm and you're quite accessible, someone like you. How do you network, and how would it be valuable for you and real estate professionals to network together?
So as a CPA, I network, or specifically working with high net worth and ultra high net worth individuals. I network mostly with estate planning attorneys, investment advisors, private bankers, different transactional attorneys who might help clients sell or buy certain types of assets. So those are the people I network with the closest. But having somebody in my portfolio of advisors who is a luxury realtor, who could help my clients buy and sell their homes, that's something that I think is something that I don't have personally, but I would definitely benefit from it. And I think it's good for realtors to have a good CPA to work with if their clients aren't getting good advice or aren't getting any advice about their transaction, if there's gain that they have to recognize, if there's a mortgage interest limitation that might apply. If they're not, and also as a realtor, you should definitely recommend to your client to talk to your CPA. Make sure there aren't any adverse tax implications of this transaction that you're not expecting, or that the CPA is not expecting and planning for, so you can get the best outcome overall.
So that's really interesting because mostly in that I think people see CPAs and attorneys as unapproachable. I have to be honest, right? I don't see it that way because I've got a relationship with you and others for many, many years. And so I fully support this notion that you need to have someone or a couple of folks, because people are different. And there are certain professionals that are better suited to others. So, in the world of a real estate advisor, and we need to be careful how we say that, right? But we have wealth advisors, we have tax advisors, but really a significant portion of a lot of people's portfolio is their home. And
right.
In this world that we're living in right now, right, this active market world, being able to be a data provider, someone who's providing actual facts. I mean, we've sat here and talked, and there's things that you can say and things you can't, right? Because you can't give certain types of advice. But at the end of the day, you would be a great advisor also to a real estate professional, right? Just having you in their pocket. I mean, I think that's really, I think what we need to convey is you're approachable, right? You do spend your time talking to other professionals. I think a lot of people think you sit around and just sit at your computer or doing tax returns, but I mean, how much of your time do you spend being out there and networking?
I probably spend 20 to 30% of my time each week reaching out to other advisors, networking with them, going to continuing education events where other advisors are there to network with. And a lot of what I do is coordinate with other advisors on client issues. So that's a connection there. And then just generally meeting other people. So I spend a lot of time not just cranking away at tax returns. I mean, as exciting as that might be. But no, I spend a lot of it's way more interesting and fun to get to meet other professionals and learn what they do, so I can help my clients and recommend other professionals to make their lives even better.
That's great. I like poking holes in, kind of preconceived beliefs. So that's great to know. And really also in the world of real estate, right? We know that realtors and real estate professionals by and large are independent contractors. But in the world of folks who can plan and time their income, there are people who are a candidate for turning that business into a more structured SCorp or something like that. You want to talk about the guidelines that are typical for that aren't specific, but are typical?
Sure. Yeah. So kind of as you mentioned, a lot of small business owners, which might be a realtor for as a very applicable example, you are generally paid with a 1099. You're considered an independent contractor in the eyes of the IRS. What that type of individual could do is form an S corporation in their state, and instead of paying self-employment tax on all of the income, you can generate a wage for yourself within your S corporation and reduce the amount of self-employment taxes that you're paying because part of your income can be distributed out to you instead of being subject to 100% self-employment tax.
And so in terms of fees, right? So we teach that you collect a professional fee, as do real estate professionals. It is a professional fee. There's a driver here when you're thinking about going from an LLC or a 1099 environment, right? That's just a pass-through into this S-Corp environment where your professional fees would need to be considered. So kind of what guidelines for income do you look at, or not income, net income?
Sure. Yeah. So the whole potential tax savings has to do with reducing the additional Medicare tax that you're paying on your net income over the amount that you're treating as wages paid out of the S corporation. So usually what I see is most clients benefit by paying the fees to prepare this type of S corporation tax return each year over the reduction in tax once they're earning maybe between $350,000 to $500,000. And a lot of it has to do with net income. And a lot of that has to do with the complexity and how clean the records are that you're providing to your CPA. If you're bringing them a box of receipts and a good luck, I hope to see you in a few months with a successful tax return, it's probably not going to be worth it. So if you're organized and provide clear information and clear data to your provider, it's going to be a tax savings at a lower net income.
Well, there's lots of tools out there that can help people get organized around this. One of them, we partner for our Institute members, we partner with a company called Hurdler that organizes you for you, right? Which is my favorite thing in the whole world, where it's kind of an enter once, use many. And so if someone comes to you really organized, they have, $600,000 of net income, right? You can really structure them in such a way that there's savings there, right? There's real savings. And this isn't, I always think about it in this way, right? Like, this is not any type of trying to avoid taxes or things like that. People are trying to pay their fair share of taxes.
Right.
Right. But when you think about your job, it's making sure that that's all they pay, right?
Right. Yeah. And there's a lot of opportunities to plan with structuring entities or timing income so that the best or least amount of tax that's due is paid. So there's a lot of opportunities if you're talking to an advisor about your taxes to make sure that that's the outcome that you achieve.
It's really interesting listening to you, because one of the words that you've used most frequently in our time together here is planning. And in different ways, right? You say, there's an opportunity to plan. And a lot of people don't think of things in that way. We just kind of go about our world and we start thinking about taxes in April of the next year. And it's too late then, right, Jonathan?
Right. I always explain to other people, I'm not doing my job if I'm not talking to my clients 4 or 5 times a year, understanding the transactions they're going through, understanding their current year situation, and helping them plan to reduce their taxes throughout the year, because if I don't start talking to them until March or April following the tax year, it's essentially too late to do anything any better than what they did on their own, which most clients, it's pretty good, but it's not the optimal amount of income or deductions to minimize their taxes.
It is. Thank you for sharing that. That's really good information. And this idea about the opportunity to plan is one really big takeaway here, just planning in general. But, I was thinking as you were talking that there's probably more common ground between a real estate professional, a successful real estate professional, and a successful tax professional, right, than most people would think of, right? You really are advising. You're not historical, right? A lot of people think of the tax person as just capturing historical information, but really you're looking forward, and you're really trying to help your clients do that.
That's correct. It's all about looking forward and creating a connection and a relationship with your clients, which a lot of realtors are really focused on. Is creating a relationship so that even once you finish this transaction, maybe in 3 or 4 or 10 years when they sell their home or want to buy a second property, they come back to you because they have that connection with you and that trust. So that's another thing that's common that CPAs share with realtors, is creating that connection with advisors, with their clients, to make sure that they have the best experience now and they connect with you in the future to do additional business.
And it's really interesting because just so many people see real estate as a transaction, right? Not any different than a tax return being filed, right? And so really in the professional world, right, you see this as not a transaction at all, right? It's an ongoing relationship that happens to have a document at the end of it that's a compliance document, right?
But yeah, I think of a tax return as a memorial to what happened in the past. So that is just us getting over the hurdle to follow the federal and state requirements to file a tax return. The most exciting and impactful thing that we can do is do the planning during the year so that when we get to that memorial of filing a tax return, it's the best result.
Right. And boy, that's that when you really look at the successful real estate professional, they're doing the same exact thing. The transaction is one event, right? And what is, hopeful to be a long and fruitful relationship, because really when you think about the luxury market and you think about real estate in general, okay, luxury is buy up. That's what that means, right? It's the buy up market. By and large, I mean, you're going to get some first-time buyers today that are looking in the luxury market, but they're not as sophisticated, right? But when you think about the buy up market and how many times someone really could need you, right, as a real estate professional, it's just no different in my mind. I think the approach is different. I have to be honest. I think the approach is different. I think successful CPAs who have your outlook are more successful because of that, right, Jonathan?
Yeah,
not a mystery. It's not a mystery, right? I always like to say that one of the things that successful people do is they pass around their advisors, right? So let's talk about your referral business. Like, how much of your business today as a partner in a tax firm is from referrals?
I would say almost 100%. Either from existing clients expanding their entities, they need more projects done, or other advisors who know that I'm a quality CPA, they enjoy working with me, they know I'll be a good fit for their client. They recommend that their client works with me as well. So then you create all these synergies with other advisors. You know how you work with each other. You know you enjoy working as advisors together. But then when you can also help the same client, the synergy just increases.
I've had the pleasure of knowing you I figured it out this morning, it's over a decade now, right? But I've watched your career. And one of the things that we teach is the very first thing you have to do is be competent, right? So if you look in your rear view mirror, right, from 10 or 15 years ago, really that first step was being competent, right?
Absolutely.
So you invested heavily in yourself there.
Yeah, so I started my practice in the private client space, so high net worth, ultra high net worth. So I've had the luxury of being in the space my entire career. So I've been taking lots of continuing education. I've been learning from other professionals in the field. I've been working with other advisors who are giving me great information to help me with my clients and their issues. So a lot of it is about technical training and learning from other people who aren't necessarily CPAs, but are advisors of these types of clients to help me understand the best way to work with these clients.
Yeah, that's so interesting. And so when you think about that, and that's how you get to a nearly 100% referral, right?
Absolutely.
It's the building blocks of doing all of those things, not overnight, right? So,
absolutely right.
Well, look, this has been a great conversation, and I hope our listeners have enjoyed it as much as I have. It's a topic that not often considered super interesting, but I think when you really tie it back to, when we look at successful people, this is what they care about, right? It's really why the Institute has a luxury market report, because I know every high net worth and ultra high net worth individual I talk to wants to understand what's happening around them. They're very well versed in things like tax laws and like what's happening in the housing market and how it impacts them.
Yeah,
so thanks for your time.
Yeah, absolutely. I really enjoyed our conversation today, and thank you for having me on.
Good. That's really terrific. And thank you, Jonathan, a lot. We appreciate it. Take care.